Welcome to Reverse Thinking, where we explore valuable investment insights together. Today, I want to share the 4 core principles that helped Warren Buffett, one of the greatest investors of all time, build his empire at Berkshire Hathaway. He's consistently applied these principles for over 50 years through periods of economic prosperity and during times of crisis. You need to understand that the market isn't a crystal ball. Even Buffett admits you can't predict which year will bring success or failure, nor can you reliably forecast short-term stock price movements. Yet the results speak for themselves. An average annual growth rate of 20% has cemented his legendary status. So, what exactly are these principles, and why have they been so incredibly effective? Let's dive in. Principle 1: Building a financial fortress. The first and arguably most crucial principle Buffett consistently emphasizes is to maintain Berkshire's financial position as firmly as a fortress. This means having ample liquidity, minimal short-term obligations, and a diverse array of income streams. It's a rock-solid commitment he makes to investors, rating agencies, and most importantly, to himself. "We never rely on the kindness of strangers to meet our obligations," he famously stated. The power of this principle was starkly evident during the 2008 financial crisis. While the rest of the world plunged into chaos and fear, Berkshire had abundant cash reserves. This allowed Buffett to invest over $14.5 billion in securities from Goldman Sachs and General Electric, yielding substantial returns in both the short and long term. This isn't just about weathering storms. It's about being in a position to capitalize on them when others are scrambling. Buffett has a strong aversion to debt. He consistently executes acquisitions with equity and believes that providing debt to any other private enterprise would be a mistake. While this cautious approach might have meant foregoing some profits in certain years, he always felt comfortable. He has a well-known adage, "It's crazy to risk what you need to get what you don't need." He deliberately constructed Berkshire Hathaway to comfortably withstand economic crises, even if the market were to shut down for an extended period. Berkshire itself serves as clear proof that short-term price movements can obscure long-term value growth. For over 50 years, the company has built value by reinvesting its earnings and allowing the magic of compound interest to do its work. This is also why he consistently opposes using leverage to own stocks. He warns that when you use leverage, your mind can become chaotic by frightening headlines from articles and comments causing suffocation, and then an unstable mind will not be able to make wise decisions. The psychological toll of debt can be just as damaging as the financial one. Principle 2: Widening the economic moat. The second principle is to expand the economic moats around the businesses you buy to provide long-term competitive advantages. One of the most important criteria for Warren Buffett when investing in any organization is that the business must possess sustainable competitive advantages, or what he calls an economic moat. As your business grows, numerous competitors will inevitably try to capture your profits. They'll study, imitate, and invade your market share as much as possible. Therefore, you must protect your profits by building a fortress and constructing moats around it to deter these invaders. After an investment, Buffett and his colleagues continuously strengthen and expand these economic moats to safeguard their long-term profits. This isn't a one-time task, it's an ongoing commitment to reinforce your competitive edge. These robust economic moats enable his company to maintain high profitability and strong growth, rather than constantly fighting tooth and nail against competitors. It's precisely this long-term vision and the expansion of these economic moats that have delivered his exceptional investment performance. For smaller investors like us, directly influencing a business's competitive advantages might be difficult. However, you absolutely need to analyze these advantages carefully. Are they sustainable in the long term? What additional advantages will the company develop to protect its profit castle? Understanding this is key to long-term success. Principle 3: Acquiring diverse cash flows. The third principle is acquiring and developing companies with new and diverse cash flows. Since 1967, when he transformed Berkshire Hathaway from a textile factory into a holding company specializing in investing in other successful businesses. His acquisition targets were carefully chosen based on 5 distinct criteria: possessing a strong competitive advantage, having an excellent top-tier management team, demonstrating good profitability ratios, offering opportunities for internal growth with attractive returns, being available at a reasonable acquisition price. He typically acquires at least 5% to 10% of a company's shares and tends to own as much of that stock as possible, provided it meets his criteria. A prime example is GEICO, a leading insurance company in the U.S. In 1976, Warren Buffett began aggressively buying GEICO shares. Within a few months, Berkshire already owned about 1/3 of the company for $47 million. Subsequently, that stake effectively grew to about 50% without Berkshire spending another dime, because GEICO itself used money to buy back its own treasury shares. 17 years later, Berkshire continued its offer to buy the remaining 50% of the company for $2.3 billion, approximately 50 times the initial $47 million investment. By Warren's estimates, by 2018, GEICO had increased Berkshire's intrinsic value by over $50 billion. This illustrates the power of identifying and nurturing businesses with strong compounding cash flows. Principle 4. Nurturing excellent management. The fourth principle is expanding, training, and developing excellent executive management staff, those who have brought great results to Berkshire for many years. This principle shares a common thread with the most important criterion he considers when investing in a company: an outstanding leadership team. But he doesn't stop there. Continuously mentoring, attracting more excellent staff, and developing succession plans for key personnel are among his top priorities. This principle is particularly well-suited to Buffett's large-scale investment style and has a profoundly positive impact on the executive team. So, what about smaller investors like us? While you may not be directly involved in developing management, you should carefully scrutinize the current leadership team of the companies you're interested in and observe how they prioritize the development of their future leaders. Strong, forward-thinking management is a cornerstone of long-term success. Conclusion: applying these principles to your investment journey. So there you have it, Warren Buffett's 4 core investment principles. These are the tenets that have helped him consistently outperform the market, despite his candid admission that predicting success or failure or short-term stock movements is impossible. Which of these principles will you apply to your own investment endeavors? Share your thoughts in the comments below. And if you found this video helpful, please like and share it to help spread these valuable insights further.